EPK Capital presents Daily Brief for 10th October 2025. First, when we thought it was safe, the inflation monster we were told was sleeping just came roaring back to life. And in the last 24 hours, it has caused absolute chaos in the markets. In this video, I'll show you the exact moment the panic started and the one comment that sent stocks into a nosedive. Hello everyone, welcome to EPK Capital's Daily Brief video. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So without further ado, let's begin. The last 24 hours have been an absolute roller coaster, a certified white-knuckle ride for investors. The inflation monster we thought was snoozing just woke up and chose violence. So today, we're going to break it all down. We're talking about the shocking inflation report that lit the fuse, a very grumpy-sounding Fed governor who poured gasoline on the fire, and why your tech stocks and crypto took it on the chin. Grab your coffee, you're going to need it. Let's get into it. All right, let's start with the crime scene. The closing numbers for Friday, October 10th. And folks, it was a sea of red. The Dow Jones fell 450 points, dropping about 1.15%. The broader S&P 500, which gives us the best picture of the overall market, got hit harder, tumbling almost 1.5% to close below that critical 5,000 level. Ouch. But the big loser of the day was the tech-heavy NASDAQ. It got absolutely hammered, shedding a full 2%. All those high-flying tech stocks felt gravity in a big way. And even the little guys, the small cap stocks in the Russell 2000 were down over 2.25%, nowhere to hide. To top it all off, the market's fear gauge, the VIX, spiked over 18% to 21.5. Anything above 20 tells you that fear and uncertainty are running the show right now. So what caused all this carnage? The story begins not today, but yesterday, with three little letters, CPI. For months, the market has been running on this beautiful, hopeful narrative that inflation was dead and the Federal Reserve would soon be our best friend again, handing out rate cuts like candy. Well, Thursday's Consumer Price Index report took that narrative, crumpled it up, and threw it in the garbage. The market was expecting a nice, cool monthly inflation number of 0.3%. What did we get? A spicy 0.5%. They were hoping for year-over-year inflation to be around 3.7%. What did we get? A stubborn 3.9%. Even core inflation, which strips out food and energy, came in hotter than expected. Now you might be thinking, hey, dude, it's just a few decimal points. What's the big deal? Well, in the world of Wall Street, that's a gigantic deal. This tells us that inflation isn't just lingering. It might be getting a second wind, and that is the Federal Reserve's absolute worst nightmare. For the market, this kills the dream of rate cuts in the near future. Instead, it screams higher for longer. The Fed is going to keep interest rates high to slow the economy down, and that is poison for stock prices, especially for those high-growth tech companies whose entire valuation is based on future profits. Higher interest rates mean the safe money in a 10-year treasury bond is now paying almost 4.9%. So why would a big fund take a huge risk on a speculative tech stock when they can get an almost 5% return guaranteed by Uncle Sam? That's the logic that drove the sell-off. And just when the market was trying to find its footing on Friday morning, the Fed decided to kick the chair out from under it. Enter Federal Reserve Governor Lisa Cook. She gave a speech today, and let me tell you, she did not come to play. She basically said, and I'm paraphrasing here, hey everyone, you see that hot inflation number? We see it too. And don't even think for a second that we're done fighting it. We will keep policy restrictive for a sustained period, and we don't care about your short-term market tantrums. Okay, she didn't say tantrums, but that was the vibe. This was a direct shot of ice water to the face for anyone hoping the Fed might soften its stance. Her comments sent the market, which was trying to rally a little bit, into a complete nosedive. It was the final confirmation. The Fed's number 1, 2, and 3 priorities are killing inflation, and they're willing to cause some economic pain to do it. And it wasn't just a US story. We also got some gloomy data out of Germany showing their industrial engine is sputtering, which adds to fears of a global slowdown. Not exactly bullish news. Alright, let's pivot to our favorite Wild West, the crypto markets. For all you crypto degens out there, it was a rough 24 hours. When the macro environment gets scary and investors run from risk, crypto often gets hit the hardest. Show chart of Bitcoin and Ethereum prices falling. Bitcoin tumbled about 5%, falling back towards that $61,000 level. Ethereum had an even worse day, dropping around 7% to under $4,000. So why the big drop? Two main reasons. First, the same higher for longer rate story we just talked about. Why hold a volatile digital asset when you can get nearly 5% risk-free? It just sucks the speculative energy out of the room. But second, we got some specific, not so great crypto news. The SEC, America's top financial cop, announced they are delaying their decision on converting the Grayscale Ethereum Trust into a spot Ether ETF. This was a huge disappointment. The market was banking on a spot Ether ETF approval to bring in a flood of institutional money, just like it did for Bitcoin. This delay throws a wrench in those plans and signals that the regulatory road for Ethereum might be a lot bumpier than we hoped. That's why you saw Ethereum underperform Bitcoin today. It was a 1-2 punch of bad macro and bad regulatory news. So where do we go from here? Is it all doom and gloom? Well, the focus next week is going to be squarely on two things. More inflation data and the start of earnings season. We'll be getting the Producer Price Index, PPI, which measures inflation at the wholesale level. If that also comes in hot, look out below. But the real show is the kickoff of Q3 earnings. We'll hear from the big banks like JP Morgan and consumer giants like PepsiCo. This is where the rubber meets the road. We'll finally get to see if these high interest rates are actually hurting corporate profits. If companies start lowering their future guidance, this market could have another leg down. But if earnings come in strong, it might be enough to fight back against the inflation fears. It's going to be a classic battle between bad macro data and good company fundamentals. True, that was a lot, but that's the story of the last 24 hours. A spicy CPI report, a hawkish Fed, and a market running for cover. The key takeaway is this: the market's easy money party is over for now. Volatility is back, and the Fed is in the driver's seat. But what do you think? Are the inflation fears overblown? Are you buying this dip, or are you heading for the hills? Let me know your game plan down in the comments. I read every single one. If you got any value out of this breakdown, do me a huge favor and smash that like button and subscribe for more content just like this. It really helps the channel out. Disclaimer, this report is a creative simulation based on your request for a specific date in the future, October 10th, 2025. The data, events, and figures are plausible scenarios designed for this script and are not real-world financial data. Stay safe out there, stay informed, and I'll see you in the next one.